Good morning, guys. This is the 23rd of May 2024. Yes, I'm doing an update on the markets. Approximately, I think, a little more than 10 days before the election results for the year get announced. It's a very interesting setup that we are really seeing in the markets, which is what I wanted to take you through. I have extensively written about the overall global setup in the long short report. And as some of you know, and those who don't, we do write daily updates on a lot of the things that you're going to hear today. And if you really want to stay updated on them, you should sign up for Indiacharts Insiders at indiacharts.com, or just download the Indiacharts app so you keep getting notifications as and when we update on any of the factors affecting the market, which vary from global macro to sentiment to what the Elliott wave counts are on the indices and so on. And of course, commodities, currencies, and the entire overall outlook is what we try to cover. So the long short report gives you the overall picture over several months, and then on a day-to-day basis, I keep writing about each of them so that you get a complete update. You can also continue to follow us on various social platforms for the same. So having said that, where are the markets today? How are they placed really ahead of the election? Everybody wants to talk about the setups after the event, but I really like to get into things before they happen. I also like to take a strong opinion on things as and when the setup tells me that it is a good time to do so. Take the risk. If we are wrong, we can always change and move ahead later. Now, I know that's not easy for everyone, and that's something that I'm learning the hard way or the easy way. I've seen it before, but now I'm seeing it, more closely with people who follow my work regularly. That you can't really always do that, but the fact is also that I don't know what else to do, because that is how I actively manage my own portfolio and my own trading. Because when the setup tells you something is possible, you consider it, seriously, even though there are alternate outcomes, and then you wait for those things to pass by. Now, it would be easy if, once you've learned a lot about so many different things and different factors, that you could simply follow one and stick to one thing. But over time, I found it important to understand what was really moving these markets, which is why I went into, macro and so on. And those do play a bit on that bias. And it may sometimes sound like, oh, you shouldn't have looked at that. But there are times when that's all that mattered. And that is why we do look at it and do give it importance, because you don't know when it means what. So one of the biggest, global factors that played on my mind as far as the bullish view I took on commodities, even as way back in 2015, I started to write about it, specifically initially starting with gold and silver, is because I thought that the dollar was peaking. It reached extreme sentiment on the dollar and looked like the dollar would be possibly in a bear market, simply because 2017 was around 7 years into in fact, I think more than that, 9 years into a dollar bull market. And that was the length of the last $1 or $2 bull runs. And so I thought in terms of time we had done so, and the last two bear markets were around 7 years. So it was an easy projection that from 2017 till 2014 would be a bull run in the commodities space. And we have seen gold bottom in 2015 and take off. What we saw though in oil, I think oil was the weakest leg, which still fell further till COVID. But some of the other commodities simply retested that low, like copper did rally, retested the low that it rallied from in 2015, didn't break it in 2020. So that was the starting point of what I called, what eventually I ended up calling as the reflation trade, when the COVID bottom was made in May of 2020. I itself wrote that first report, and that's been the tracking point. Now, the thing which almost broke that opinion was the big rally in the dollar in 2022. So that surprised me, because I didn't think the highs would get taken out, and they did. However, on a long-term chart now, what I actually look at, and some of you may have seen it in my Forex analytics interview, is that the entire rising dollar was in a rising channel, so, and it's reached the top end of the channel in 2022. So what this means is, have we really completed, maybe time-wise longer, but a complex long bull run in the dollar index, which in Elliott wave terms we mark it as WXYXZ. Now, why is all this important from a macro perspective? Is because once you do, end a dollar bull run, you actually get a period where the dollar remains weak, and that supports emerging markets, the commodity cycle, and then within that, of course, India, because India is was in that basket of so-called emerging markets. Basically, one of the places where India actually ends up attracting funds from abroad. So essentially, what ends up happening in a dollar bear is that a lot of the liquidity that is created in terms of dollars ends up going into other assets and other markets. And so that is why it's a very, very interesting phase. And why did we start thinking about all of this? Because that is what ended up happening in the last bull market, right? We all know 2001 to 2008, and then the GFC crashed it all for some time. But that bull run was backed by a period when the dollar was weak, commodity prices were rising, and so you had equities and commodities rising together. Very unusual. Most people think that they are inversely correlated, and that proved to be wrong, simply because the dollar was fueling a lot of this. And of course, the weak dollar meant low interest rates. Now, interest rates have started to turn, and there's enough talk about the long-term rate cycle having permanently changed, which is interesting. But like any trend, there must be pullbacks, and so a lot of time I've spent over the last year thinking about whether the US bond market actually has made its fifth wave for this leg, at least. Whatever started in 2020, the bond yields had hit their lowest level, and from there we are trying to count 5 waves down. Fifth wave over, not over. So last year I thought over. Markets did rally, then I thought maybe not over because it didn't cross the 20-month average, and yields actually went up in the last 6 months. But once again, as they got to the lows, I see a lot of short covering in the US bond market, which means the bond bears are backing off from their bearish trade. And the Fed has, of course, spent most of the last year saying, we want to cut, we want to cut, we want to cut, even though the data is not helping them. They've gone ahead this month, which is in May of 2024, earlier part of this month. They've gone ahead and reversed quantitative tightening, and simultaneously the Treasury has also announced that from June onwards they will be buying $2 billion a week of bonds through a buyback program, the first time in more than 15 years. So these become very, very interesting data points in terms of what happens to liquidity, because if you have a rising dollar, you had rising rates, you had a tight liquidity environment, even though they were providing liquidity through many other measures. But now this is more openly being done, and various other places you actually have an environment in Europe where inflation is actually coming down, and they can bring down rates. So you'll have a environment where liquidity is expanding, not just because of the US, but also because of Japan, Europe, China, and so global liquidity again starts to rise. Right? This is the thing which really changes views. So then that brings us to the technicals of our own market and how the setup is ahead of the elections. Like, except if we can just remove this uncertainty about who's going to win, how many seats will come, will that cause volatility on that day or not, that very little short-term bit. Except for that, the really big picture issue here is if you remove that, which is an event risk, then it's really about how the world markets are set up, how India is set up in more particular, and that's what I'm going to spend more time on, because we talk a lot about sentiment indicators, and now all sentiment indicators that I used to use over the last 15-20 years are on strike, so which means everybody has access to them at a throwaway price of what, $650 per month or something that strike really charges you. And why is it important at times like this? Because in January, when the markets rallied very hard on the expectation that with the state election wins, can you really get past the 400 mark in terms of total seats for the ongoing government, which is the BJP. And if that is the case, what would it be? So the markets rallied, and that enthusiasm led to a situation where the positioning, right? So in sentiment, what is sentiment? It's either survey of whether traders are bullish or bearish, or the other is positioning. Right? How is the positioning? How is the breadth? What is the put call ratio telling us? Which is also positioning, right? How many calls and puts have been sold or traded is positioning. Many of these indicators were turning excessively bullish in January, which means people were overly bullish, and therefore there was a reason to think that markets need to correct. Now, what has ended up happening between Jan, Feb, March, April is when we just look at the Nifty. Of course, some stocks have done well even in this phase. Simply look at Nifty, it's gone through a consolidation, right? So it's sort of flattened out and then gone this way, maybe a little higher, but sort of in a range. And so this consolidation we only know it's a consolidation when you reach the end of this period. You don't know at the beginning, because you don't know whether prices will simply move in a range and then head higher again, or will they actually break the lows, do some kind of a retracement correction, or can something more bearish really happen because bond yields were rising, right, back to the macro factors that I started off with. So that didn't happen. Rising yields didn't hit the market. The bonds have covered their short, so that changed the situation, and now liquidity is rising. And then in our own market, because of this consolidation, the positioning, which is brings us back to sentiment, right? The positioning, which you can see in the participant charts on strike, simply went from extreme long to sort of short. Okay. And in fact, on the client side data, they did go from extreme short to extreme long also. Right now, they've reached like the second or third highest long positioning in terms of data over the last 2 years that we've seen. And that means that typically when we've seen this kind of a setup, where the FII data is extremely short on the futures, we're talking of index futures, right? This is the data that NSE puts out every day. So in index futures, you have an extreme short position by one group and you have an extreme long position by another group. And historically, that has meant that the market goes up. So this was the setup 2 or 3 weeks back, and then in between, as the market started to bounce back from 21,800, we also saw the put call ratio based on open interest to reach the bottom end of the range. So all of these things coming together sort of meant that sentiment had suddenly flipped on its head. Where you had January was all bullish, 400 par, and now you had sentiment saying, questioning even the possibility of whether you'll get 310. So that's how vivid markets are. But the beauty is that if I remove the event from this, and if I was only looking at this data, it simply meant that if positioning has changed and sentiment has changed, then your view should also change. And that is what I have actually ended up doing, which is going from thinking bearish in Jan, Feb, March and so on, waiting for a correction, to now thinking, well, it's not a correction, it's a consolidation. And so markets need to head higher. And that is the big change. That along with liquidity means the global setup is also good. The domestic setup is also good. The only thing in the way of markets going higher from here is this event, right? The election results, what will it be, and all the confusion which is getting priced into the rising VIX. A couple of people have been saying, does the rising VIX mean the markets are going to fall and so on? So we would have thought that maybe the first time we saw this phenomena in 2014. But the beauty of markets is that, they create volatility once around an event, and then every time that event repeats in future, at that point of time, the market gets smart and prices it in. So usually you don't benefit from that event if it goes this way or that way, because the VIX has priced it in. Even if the market moves 3-4%, the VIX would have risen so much that if you're just buying options a few days before the event, then you don't really benefit unless you bought it at a very low point. Now the one thing what sentiment caused this time around, end of April, the VIX had actually dropped to 10, which is a very, very unusual, because prior to the event, we haven't seen such a sharp fall in VIX. And that means that at the end of April, you could actually get options very, very cheap in terms of the event, because the sentiment changed from, this extreme thing of an all-out win to, is it really going to happen or not? And that may have been an opportunity for some people to position more than a month ahead of the results at a good price as to where the markets are headed. And the positioning was there, so we've been talking about it since April that the setup is for upside. Now what has happened? The VIX has gone from 10 to 21. Now that is in line with what we've seen in the last 2 elections. We didn't see VIX drop to 10 in the last 2 elections, but what we saw in the 1 month prior to the election results, the VIX went up from 15 to 25 or 28. In 2014, it went as high as 35 just before the result announcements. And in 2019, it went up to around 28 just before. We are at 21 right now. I think in the next 7-8 days, I won't be surprised if you even go up to 25, 26 just before the results, or similar like last time, even 28. So somewhere in that range, between 25 and 28 is where we should be. But once the results are out, do expect the VIX to halve from there. So even if it's 28, it'll come back to 14. That is what happened the last time. That is what I think will happen again. But that doesn't mean that the market is going to fall or rise. That has nothing to do with the market's movement. This is just pricing in the volatility that comes with election results, because 2004 mein aisa hua. So that is the starting point, right? So similarly, if you have noticed, every time Infi's results are coming, the options for tech stocks, and specifically Infi's own stock options, become overpriced. Why does that happen? Because in 2001, when they announced their results for the first time, they missed their guidance. Infi stock went down 2 circuits. And that meant that there was a lot of volatility on that day. And after that, every time its results are announced, the VIX for Infi prices in the potential of this kind of volatility. And so the same thing has happened with elections also. Because 2004, you had a big swing, 2 circuits down on election results. In fact, 2009, then you had a big up day, almost a circuit level on election results. It means every time there's a major central election, the VIX is going to shoot up. And that's what you're really seeing right now. Because imagine the seller of options has to price in that risk, right? They have to hedge it. So they're not, if they see that, markets can move 5-10% either side, they cannot sell you options for 14% VIX, right? They're going to charge you more, and that is what they're really doing, and then they're able to hedge that better. So that's all the VIX really means. It's simply event risk getting priced into markets, that there is volatility on this event day. But which direction will it be has to do with the trade setup. Now, markets historically are always smart. They always move in the direction of the trend that they anticipate things to be in. For example, 2004, before the markets crashed, it had already topped in Jan of 2004, and it was falling, not very sharply, but all through Feb, March, it was zigzagging on the way down, and eventually in May it sold off. In fact, even before the election results, it was falling. Results came out, a day it was flat, and then next day, they thought that it's a coalition government, and then it went lower circuit. So it sort of anticipated that in advance. Similarly, 2009, the market was already rallying before the results, and then it hit the upper level, and again it had anticipated things in advance. So the next 10 days as we go into the elections, I think the markets will anticipate what is going to come out. 2019, we did see some confusion, because that time actually there were doubts as to whether they'll hit, go from 290 to 310 or not. And so the markets corrected in April and were at the lower end like 3 days before the election results, but then they started to rally ahead of the announcement itself. So the last 3 days was up, and then there was a gap up. So and there was a positive surprise. Now, what eventually happened is markets did roll over after the election euphoria, and that again brings us back to positioning. What was the positioning at that time? What were the global setups of global markets at that time? And in 2019, global markets were volatile. They were going through a long consolidation of a larger degree. So that pressure was already there, and positioning was, what I've been talking about, client FIA positioning, was on the long side, which means there was excessive long, which was unwinding on the FIA side. And so that, even though markets bumped up, longs got added again, not as much as they were before the election. And then after that, unwinding started. This time around, unlike 2014 and 19, we have the whole thing flipped on its head, which means that the positioning is not what it was in the last 2 periods. Okay. Both of those times, the positioning was the opposite of this time. To some extent, the markets were short. Even though 2014, the markets went up irrespective, but they were on the short side. This time, the positioning is the reverse. Okay. The FIs are short, clients are long. Last 2 times, the FIs were long and clients were short. And this reversal of position, and also to an extreme degree, can be thought of as, is it going to be contrary? But if I think of it as how has this data been working historically, it's directional. Okay, so directionally it says the market wants to go up because the global setup is right, global liquidity is right. The only thing is you have an event, and if the event is favorable, it's a double, gamma on the upside. If it's not favorable, you will get a day's volatility, and not favorable only means whether you got so many seats or so many seats. I don't think anybody's expecting there would be a complete, change in government, or there would be a coalition of a type which is, unable to control matters. That would be a negative, but that's not the mood as what I'm able to sense, during these elections. More than any time before, I think the mood is been more positive, about whatever is going on. So that's just what it is. So yeah, while all that can happen, if the markets anticipate, which means they're going up as they are doing today, if they continue to rise into the event, I would say just like 2014 markets are, or 2009 markets are anticipating a positive outcome, because that's what they've always done. If they wanted to fall, they usually anticipate the negative outcome, fall ahead of the event, and then they fall further. That's what we saw in 2009, and that's what we saw even with the Infi example I gave you in 2001. The stock was already in decline for a couple of months before they actually announced the failure to meet guidance. So Many times markets are anticipatory. It's not always shock and awe. And that is why if the markets remain positive, into the election results, I would think that the outcome is going to be positive. That's my in a nutshell conclusion. So I've spread my discussion over two things. One is what the data and sentiment is telling us. Two, what is the macro telling us? And three, how do markets really anticipate events? Events are not the cause of markets. Markets are the cause of events. This is the end. There's an entire social theory around it, because it is social mood that determines how markets behave and where they head. The mood of the crowd, the mood of the public as a whole is what is reflected in markets. Their buying and selling is a function of their mood. If they're feeling good, they invest, they buy stocks. And so that is the theory around social mood. And so therefore, like I said, if markets are going up, they're actually anticipatory. It's not that the news comes and therefore markets move. Markets move before the news comes. By the time that you come to know what the news is, the market has already discounted it. That's just how they work. And that is why we use things like data, sentiment, macro, global, to be able to think about how things will go. And like I said, all of those things are pointing up. And if the markets do pay heed to that and stay positive into the result announcements, they're sort of anticipating that the announcements also will be on the positive side. That's all from me for today. Until next time, don't forget, subscribe to Strike. It's a throwaway price to be able to get these kind of data analytics and 100 other tools which will help any investor and trader spot two things. I mean, we've now pretty much outlined what it helps you do. Sentiment and indicators, and those studies allow you to know where the market is. And then the next level is scanning and searching, which allow you to filter and drill down to the stocks that you should be trading and investing in. So you don't want a list of 100, you want to come down to 4 or 5. That is what it helps you do. You have to start using it and figure it out. We do webinars every Saturday. We're going to be doing one this weekend as well. So you can join us for those. These are free webinars that help you to learn each and every topic. Most of those videos are published on YouTube. So that's another place to go. Strike_IC is the tag that we use for the Strike tool on Twitter and on YouTube. So all the YouTube videos related to Strike, how to use it, all the webinars are published on the YouTube channel of Strike. So you can go there and learn about it, as well as come for the interactive webinars and ask your questions there as well. So see you all there. And for my updates, like I said, join me on the Indiacharts app, Android, iOS, wherever you want. And I'll continue to post on all of these topics, the individual trends across these different markets on a day-to-day basis. Thank you.